VantageScore 4.0 is now being used in mortgage. Here's what that means. VantageScore 4.0 is officially entering the mortgage conversation. And this matters. But before anyone turns this into a headline that causes confusion, let's slow down and be very clear about what this actually means. This week is all about how these changes affect loan officers, so save this or send it to a loan officer that you know. Because in mortgage, details matter. This does not mean every lender is using VantageScore 4.0. This does not mean FICO disappeared. This does not mean borrowers can now take the score they see on a consumer app and assume that is the score being used for their mortgage approval. And it definitely does not mean the entire credit scoring system changed overnight. What it means is this. Fannie Mae and Freddie Mac are moving through an interim phase where certain approved lenders may be able to deliver loans using either classic FICO or VantageScore 4.0. That is the part mortgage professionals need to understand. The word is approved. Not automatic, not universal, not every loan, not every borrower, not every lender approved. And that distinction matters because mortgage lending is not driven by headlines. It is driven by guidelines, investor requirements, underwriting systems, lender overlays, product eligibility, documentation, and risk assessment. So yes, VantageScore 4.0 entering the mortgage workflow is a major shift. For decades, mortgage lending has relied heavily on legacy FICO models. Those models have been deeply embedded in the way credit risk is evaluated, the way loans are underwritten, and the way files are delivered into the secondary market. Now, we are seeing credit score competition move out of the policy conversation and into real mortgage operations. That is important. NewRez has already helped validate that VantageScore 4.0 loans can move through the process. That means origination, underwriting, pricing, delivery, and securitization have been tested in an approved channel. UWM has also announced expanded access to both FICO and VantageScore options for conventional loans. So this is not just theory anymore. It is starting to show up in the actual lending environment. But here is where mortgage professionals need to be careful. Just because something is available in the market does not mean it applies to every file. A score model still has to be accepted by the lender. It has to align with the investor. It has to work with a loan program. It has to be allowed within the system being used. And the borrower's full credit profile still matters. This is not a shortcut around underwriting. It is not a replacement for reviewing credit accurately. And it is not a guarantee that a borrower will qualify, receive better pricing, or have a different outcome. It is another accepted scoring option in certain approved channels. That is the accurate way to say it. And this is exactly why communication matters right now. Borrowers are going to hear pieces of this. They may see VantageScore in a consumer credit app. They may hear that VantageScore is being accepted in mortgage. And they may assume that means their online score is now the one that controls their home loan. That is where confusion starts, because mortgage credit reporting is more specific than consumer credit monitoring. A mortgage credit report is pulled through approved systems. It uses accepted score models. It has to meet lender and investor requirements. So the borrower-facing score and the mortgage decision score may still be very different conversations. For loan officers, brokers, real estate agents, and anyone guiding borrowers, the responsibility is to explain this clearly. Not dramatically, not with hype, clearly. Here is the message. VantageScore 4.0 is beginning to be used in mortgage lending through approved lenders and approved channels. That is meaningful. It may expand access and create more credit score competition over time. But it is not universal yet. FICO is still very much part of the mortgage landscape. Guidelines still apply, underwriting still applies, investor acceptance still applies, and accurate credit reporting still matters. So when someone asks, does this mean mortgage lending is changing? The answer is yes, but carefully. The industry is moving, the models are evolving, the conversation is changing. But the responsibility stays the same. Know what score model is being used. Know which lender and investor allow it. Know what the borrower's actual mortgage credit profile shows. And set expectations before confusion becomes a problem. Because in lending, accuracy matters more than headlines. And the professionals who understand that will be the ones borrowers trust most.